Chief Investment Officer of Lombard Odier Darier Hentsch&Cie. Lombard Odier, as you probably know, is one of the oldest Swiss private banks, established in 1796, after French Revolution, but before Russian Revolution. The bank has been through many crises, tens of crises, I should say, and still preserved its stellar reputation for being a conservative and long-term oriented investor. And it's not a coincidence that Paul is working as a CIO of this bank. Paul has also had a long career, short but long career in finance, after working in the UK Treasury, working in JP Morgan, in Goldman Sachs, and in Morgan Stanley. Asset management teams both in Goldman and Morgan. Paul was a managing director, which, as you probably know, is the partner level position in global investment banks. Paul has graduated from Queen Mary and Cambridge University with master's degree, and as some of you have seen him on Russian TV yesterday, he has some interesting controversial views on global macroeconomics. And we agreed that Paul will first summarize his views on major global macroeconomic issues, and then we'll have a discussion, questions, answers.
Thank you. What I thought I would do is cover maybe 2 or 3 of the key themes that really come up continuously when we talk to clients. The first one, obviously, is the sustainability of the sovereign debt position in Europe. So the likelihood of a Greek default or a Portuguese default or a default more generally. The second issue would be the idea of quantitative easing. There's a lot of interest in quantitative easing, the effect of quantitative easing, the impact of the withdrawal of quantitative easing, I think, is interesting but hasn't really been touched upon. And then lastly, if I touch upon sort of the next stage of the crisis. I often get asked, what comes after the euro sovereign debt crisis? Which country goes next? Particularly Russians are very keen on knowing what comes next, what's the next crisis. And I think the next crisis after the European sovereign crisis is Japan. I think Japan will default on its debt within 3 to 5 years. People often have that look. It's not surprising. So I think Japan will default on its debt within 3 to 5 years. So that's the next one to go. So let's really start on the fiscal policy issue. Now I'll talk about fiscal policy and fiscal sustainability. Feel free to interrupt at any point in time if you want to cover something different, or if there's something that you don't understand or something you ideally disagree with, because we'd like to hear any disagreements with the views. Now, a lot of people talk about fiscal policy and fiscal sustainability, and everybody thinks that the Greeks and the Portuguese and the Irish need to tighten their budgetary policy. But very few people actually tell you how much they need to tighten by. So it's just taken that they have to tighten fiscal policy, but you have to ask yourself, how much is necessary to tighten fiscal policy to stabilize the situation? Now, you're all graduate students in economics, and so you know the arithmetic of fiscal sustainability quite well. It's very clear that you can calculate what level of fiscal policy adjustment is necessary to stabilize the net debt to GDP ratio. So that's really what we've done. Now, let me just go on, and I'll come back to this slide. So the maths you can go through separately, but the key point here is at the bottom. To keep the government debt to GDP ratio constant, you have to run a primary surplus as a percentage of GDP, which is defined by the equation at the bottom. Any country which has a positive net debt, like the Greeks, like the Europeans, like the British, any country like that, if the rate of interest they pay, the effective rate of interest that they service their debt, exceeds the rate of growth of their real GDP, then they need to run a primary surplus. The arithmetic is really quite simple. If you want to get the background to this, you should just read anything written by Willem Buiten, who was a professor at Cambridge and at the LSE and was on the board at the Bank of England for a period of time. But it's very clear that this is the fiscal sustainability condition. So the key variables are real interest rates and the real growth rate. Really, those are the key defining variables behind fiscal sustainability. So where does that leave us? Okay, so where it really leads us is here. This is a table which shows the fiscal position of the major countries in 2010. This is OECD data. So the column here shows gross debt to GDP ratio. So the gross debt to GDP ratio in the US is 93. If you expand that data to now, it's a little bit higher. So it's probably closer to 99 now. You can see Germany, Spain, and everyone else. This is the net debt to GDP ratio. The third column is the budget deficit, so the flow of new debt, which adds to the debt to GDP ratio. This column is the structural balance, and what that is, obviously, is the budget deficit adjusted for the effects of the cycle. And in effect, what this is the budget deficit you can't grow out of. So this is the structural deficit that you can't grow yourself out of. You have to tackle this with fundamental fiscal policy measures. And then on the right-hand side, you have the cyclically adjusted primary balance. So what we've done here is that, you know, the cyclically adjusted primary balance is basically the deficit excluding debt interest payments. Because most countries would prefer to pay their debts and pay their interest payments. And so if you exclude that, the only part of fiscal policy which remains discretionary is the primary balance. And if you cyclically adjust it, you see really the underlying structural position excluding interest servicing costs in each of these countries. And so what you see is a pretty desperate picture. The US is running a cyclically adjusted primary balance of 7% of GDP at the end of 2010 by OECD data. You see UK and Japan at 5 to 5.5, Portugal at 4.5, Greece here is 0.3 negative. In fact, this should be much larger. I think the OECD data will be revised subsequently. That will probably be closer to sort of 7 or 8% of GDP, so substantially larger than that. So that will need adjustment by the OECD. And then you've got the others, including Italy, which is the only one really which has a structural, cyclically adjusted primary surplus. So the key point is, this is where you're starting from. So this is the fiscal hole that you're in. How do you dig yourself out of it? Well, the degree to which you need to dig yourself out of it will be a function of real interest rates and the real growth rate. So, how much needs to be done? We'll come back to this in a second. That looks quite horrible, but it's quite useful, in fact. What needs to be done is here. What I've done here is I've calculated the equilibrium primary balance. So what I've said is, okay, what if these countries all face their long-run average real interest rate? So quite a heroic assumption. Now, given where Greek interest rates are, that's a very heroic assumption. So let's just start there and work our way forward. So if each of these countries faces their long-run average real interest rate, and at the same time each of these countries grows at their long-run trend real GDP growth rate, so it's an equilibrium path. If you follow that path, if each of these countries follows that path, this is the primary balance which is necessary to stabilize the net debt to GDP ratio in each of these countries. So, for example, in the US, you need to run about a 0.3% of GDP primary fiscal surplus to stabilize the net debt to GDP ratio at that 68% level. So the gross debt around 93%. That involves a swing from 7% deficit to 0.3 surplus. That means that the US needs to implement permanent fiscal policy tightening in the order of about 7.5% of GDP. Now that's a permanent fiscal policy tightening implemented either through spending cuts and or tax increases. And we can get to the optimal path that should be followed later. If you look at...
But this is assuming constant savings, right?
Yes.
And if interest rates changes, the savings...
Absolutely, absolutely. This is an equilibrium path with nothing changed. The second key point here is that obviously it's unlikely that these countries will generate trend GDP growth. It's going to be quite difficult for the Portuguese and the Greeks and the Irish to grow at a trend rate, given where they are. And similarly, they aren't facing historical normal real interest rates. So let's relax the assumptions a little bit further. If you assume that they grow at their trend GDP growth rate, but they pay current real yields, the maths becomes a little bit more unattractive. What you find is that the degree of fiscal policy tightening in Ireland, Greece and Portugal is, you can see, between 8 and 10%. If you then make a further adjustment and say, well, they don't grow at their trend real GDP growth rate, but they grow at, let's say, half of that, these numbers shift up again quite materially. So it's pretty clear, we think, that the degree of fiscal policy tightening that's necessary in Portugal, Ireland and Greece to stabilise their net debt ratio where it is today is probably somewhere of the order of 10% of GDP. Now, I can't think of any country that's implemented that degree of fiscal policy tightening really in peacetime. That's a draconian fiscal policy path for these countries to follow. Now, it also happens to be the case that if you look at these countries, one of the reasons why they got themselves into the situation they're in is because they basically inflated relative to Germany. if you take unit labour costs in Germany after the implementation of the euro, unit labour costs were broadly flat. Relative unit labour costs in Portugal, Ireland, Greece, Spain and a number of other countries expanded by about 20 to 30%. So they have a cost premium of maybe 30% and they need to implement this kind of fiscal policy tightening. So the environment that you would see for some of these countries is fiscal policy tightening of, let's say, 10% of GDP associated with a decline in nominal income in the order of 20 to 30%. I just simply don't believe that that's possible. I don't believe that Greece, Ireland or Portugal can implement a fiscal policy economic adjustment on that scale. I think the only real path that they can follow is really to default. I think default is kind of the optimal path for these countries at this point in time. Now, you could say, well, okay, I don't kind of believe that very much. It's interesting, but I don't believe your assumptions. So what I've got here is, this is just a little matrix. It kind of looks a bit worse on the screen, but we'll give you a handout of this. What I've got across the top on here, this is basically the real interest rate that these countries pay. So this is real interest rates going from sort of minus whatever it is to plus whatever it is, plus 8. And this is the real GDP growth rate. So in given equilibrium, what you can do is you can measure across and say, well, actually, I think growth will be X and I think real interest rates will be Y. And you can determine yourself what level of primary surplus is necessary. Now, this is for the US, as you move to the right and you get towards relatively elevated levels of real interest rates, and obviously you move GDP growth up to comparatively depressed levels, you can see that the required primary surplus becomes really quite substantial. So it really wouldn't take much of a rise in real interest rates before, for example, the US doesn't need 7.5% of GDP fiscal policy tightening. It would need 8.5 or 9.5. So the numbers that we're talking about are really very, very substantial. The major economies need almost draconian fiscal policy tightening. Just tightening policy by 1 or 2% of GDP just doesn't work. It's just not enough. So you have to do really very substantial amounts of policy tightening. The question then is, well, how much do you do? And how do you do it? Well, what we've got here is, first of all, we've looked at Reinhart and Rogoff's work. Now, you should be familiar with this. They looked at the history of fiscal policy tightening. This time it's different, and in fact it never is. And what you have here is you have the rate of real growth which is achievable according to debt to GDP ratios. And it shows really the conclusion that they put in the book, is that once you get beyond the, say, 90% debt to GDP ratio, you tend to see a structural break in GDP growth. Now, we can argue about causality, and Reinhart and Rogoff have engaged in arguments about causality with Paul Krugman, amongst others. I happen to fall on the side of Reinhart and Rogoff and not really on the side of Krugman. I do think there is some sense of causality from elevated debt levels to slower growth rates. It could go through Ricardian equivalence types of effects, it could go through default premium effects in the capital cost structure. But I think it's very clear that you do see structural breaks in GDP growth rates beyond particular thresholds in debt levels. So the situation you have is that for many of these countries, they are beyond this 90% threshold. So they need to tighten fiscal policy at a time when their underlying structural trend rate of GDP growth could be meaningfully lower than it was historically. So again, you're reducing the achievable level of real GDP growth. You're working at real interest rates which are above equilibrium levels. Again, you're pushing yourself towards ever greater amounts of adjustment in the cyclically adjusted primary balance. Again, it supports the notion, I think, that the degree of fiscal policy tightening needs to be really very, very substantial. Now, how do you do it? So how do you tighten policy? Well, the interesting thing is, we've looked at a paper by Alberto Alesina, who's a professor at Harvard. You might have seen this, looking at the history of fiscal policy. There are a number of other studies that have been done. McDermott, for example, at the IMF, published a paper on this a number of years ago, looking at the success rate of policy tightening. So it's pretty clear that you need to tighten fiscal policy. You need to raise spending and cut spending and or raise taxes. But how much do you do, and what's the balance between the two measures? Now, when you look at it, if you look back at the history of these fiscal policy tightening episodes, what they found is that really, generally speaking, when the adjustment was biased towards spending cuts, the success rate, measured in terms of the effect on a sustained reduction in the primary deficit and a sustained reduction in the debt to GDP ratio, the success rate is substantially greater when you bias the fiscal policy tightening towards spending cuts than it is when you bias the fiscal policy tightening towards tax increases. And generally speaking, what you see is pretty much what most governments have been implementing. Roughly about 2/3 of your policy tightening should be implemented through spending cuts, and 1/3 should be implemented through tax increases. So you really need quite substantial spending cuts on a structural basis in many of these countries. Now, Alestina also produces this interesting table. This is from 2003 from Eurostat, but it doesn't really change much if you update it. What it looks at is the black bars show you the proportion of the population at risk of poverty before social programs are implemented. So, for example, just over a fifth, let's say a quarter of the Germans, Italian, Spanish population are subject to poverty risk prior to the implementation of social welfare. The orange bar shows you the proportion of the population who are at risk of poverty after the implementation of social welfare. And obviously, the bigger the gap between the black and the orange, the more efficient or effective the social welfare system is. Now, it's kind of interesting when you look at it. The countries which are in most trouble, Portugal, Ireland, Greece and Spain, funnily enough, have really the most ineffective social welfare systems. So the idea that you can, quite plausibly, tighten fiscal policy very aggressively by cutting welfare spending really quite aggressively, and you could have relatively modest effects on the overall levels of distress or poverty in an economy in aggregate. So it's quite evident, I think, that you could take a knife to large parts of the welfare system in many of these countries and not really have a noticeable damaging effect on the level of social welfare. So it wouldn't be difficult, I don't think, for these countries to implement this policy tightening. It could be implemented quite easily. You just cut spending on the welfare budget. So that's the first key point that we wanted to make, is the idea that I think for Portugal, Ireland, Greece, there really is no way back, we think, for them. They really have a preferred path which would be one towards default. The degree of fiscal policy tightening necessary is simply too large for them to be able to implement that plausibly. The question is then when? Well, the European Stability Fund is in place. That could support these countries really through till 2013. So really the path that they probably follow would be to stretch this out to 2013, and in 2013 undertake a default. Now, how would the default work? And would it work? Well, the key thing is that default only works if you have a cyclically adjusted primary surplus. Because if you default when you've got a cyclically adjusted primary deficit, what happens? You stop paying your interest payments on your debt, but the very next day you still have a deficit. You still need to borrow. And the fact is that the Greeks, the Portuguese, the Irish all have cyclically adjusted primary deficits. So until such point they can bring their primary deficits into surplus, a default really doesn't help them much. All it does is it sweeps the table clean and allows them to start accumulating more debt afresh. So it really starts the problem again rather than eradicates the underlying fundamental problem. So really the best path for them to take would be to bring their primary deficits up to something like balance or even just modest deficit, and then at that point default. That would be the preferred path. And they have the ability, a window of opportunity to do that really out to 2013 under the support of the European Union. Now, the second key point that we want to make is the idea that the next country to go after that would be Japan. Now, I think a lot of people have talked over the years about Japan and its unsustainable debt and the amount of leverage in the economy and the idea that Japan could default. And it's sort of, the old joke is that graveyards are full of hedge fund managers who tried to short the Japanese government bond market over the last 20 years, and it's never been a good trade to do. And I think the reason why it's never been a good trade to do is really simple. The top left picture shows you the budget deficit, which is the black line. So up here you're in deficit, here you're in surplus, we just turned it up. So this is the budget balance, and the orange line is the level of net domestic savings as a percentage of GDP. Now it's relatively simple. If you're running a budget deficit and you have a surplus of net domestic savings over and above that budget deficit, you can finance internally domestically. And that's really what the Japanese have been doing. The Japanese have had no reason to turn to international financing for their budget deficit over the last 2 decades because they've had ample surplus domestic savings. They've been awash with domestic savings. Now, what that means is that, for example, the Japanese household sector has a vast amount of cash. It has about, 51% of its financial assets in cash. That's really being used largely to finance purchases of JGBs through the postal savings system and other sources. So the surplus of savings has financed the budget deficit very, very simply. The problem comes is that the level of net national savings as a percentage of GDP is really declining steadily. And we think on current path, it looks like the level of net domestic savings is going to fall short of the budget deficit at some point in the next couple of years. Now, at that point, you have to start selling to foreigners. Now, if you were Japanese, buying Japanese government bonds yielding 1.5% makes a lot of sense. Because if prices are falling by 1 or 2%, you're earning a real return of 2 or 3. There aren't many financial assets in the world in the last 2 decades that have earned 2 or 3% real return. So from a Japanese perspective, it made a lot of sense to buy low-yielding JGBs with your savings. But from a foreigner's perspective, why would you want to buy 1.5% yielding JGBs with a currency which you could argue is a little bit overvalued? Why would you want to do that? Why would you want to buy a 1.5% yielding asset in an overvalued currency? So what we think happens is that that eventually will drive interest rates higher. At the point where they have a deficit of net domestic savings, it will drive interest rates higher. And I'll talk a little bit about the effect of that very shortly. Now, one of the issues in Japan you have is the aging population. You see here that you have a rising number of dependents and a falling number of workers. So the dependency ratio is rising very, very steadily. As you get a rising number of dependents, so a rising number of retirees, what you see here, this is from Horioka, is that you see the savings ratio broken down by age cohort. And it's quite clear that the savings ratio for retirees is very, very negative. So the more retirees you have, the more negative the savings ratio. The Japanese savings ratio drops effectively to nothing. The Japanese are not a nation of domestic savers. The corporate sector saves, but the household sector is not a nation of savers. In fact, quite the opposite. So when you add that together, you look at the current state of Japanese finances. There are 2 key things. The ratio of government debt to tax revenue. This is something that Reinhardt Rogoff themselves also highlighted. 420% is the historical tipping point if you take a Gladwell type of view. The Japanese are way beyond that. You can see that the Japanese are really way beyond the scale of 420%. They're way beyond anything that's sustainable. And then the bottom right you have the amount of revenue that the government has which is absorbed by debt service. Now, at the moment for Japan, it's 1/5 of their revenue is used in debt service. You can do a simple calculation and calculate what's the effect of, say, a 1% rise in the cost of capital to the Japanese government. A 1% rise in the cost of capital to the Japanese government means that they need to divert between 1/5 and 1/4 of their revenue to debt service. So you can see that if you take interest rates up by maybe 3% from here, the Japanese government is going to be spending all of its revenue on debt service and will have nothing for social security, education, or any other kinds of welfare programs. So at that point, the point where interest rates start to rise, the Japanese budget is extremely sensitive to higher interest rates. It doesn't take much of a rise in interest rates before you really bankrupt the Japanese government. And incidentally, the Japanese opposition are talking about Operation X Day. Now, I think the Americans had a plan for invasion, which they called Operation X Day. And the Japanese opposition have termed Operation X Day the plan for the day when the Japanese can no longer finance their budget deficit internally and they have to rely on external financing. Now, it doesn't take much, as I said, of a rise in interest rates before you see the Japanese government run into a shortage of cash. Now, why would interest rates rise? Well, interest rates would rise when foreigners are forced to buy these bonds. They won't buy them at low yield levels, they'll buy them at much higher yield levels. Yield levels akin to German or US levels would bankrupt the Japanese government. It doesn't take much to tip the Japanese government into bankruptcy. So the Japanese default is an option at this point. The other option is that they print large amounts of money and the Japanese central bank just buys large amounts of debt directly. Well, in effect, huge monetization of a budget deficit is akin to default anyway. Whether you stop paying or whether you just pay something in a debased currency, it's the same thing. It's a default by a different name. So the likely path is that the central bank would have to step in and buy large amounts of JGBs to continue to finance the deficit. But of course that would raise inflation expectations. A rise in inflation expectations would raise nominal yields. The rise in nominal yields would really bankrupt the government. So it seems to us that the tipping point for Japan comes when net domestic savings fall short of the budget deficit. That point is really not far away. That point is probably maybe just a few years away. So this would be the next considered crisis. So we've covered European sovereign issues. We've covered Japan. Let's then talk about monetary policy and quantitative easing. So how does quantitative easing work? Well, let's just go through a little bit of theory first of all. I'm an economist by background, and I shouldn't say this in this kind of place, but there aren't many things in economics that actually really work terribly well. No insult to economists, but in my experience, I haven't found many of the things that I've learned that I can really apply in a terribly successful way. This is one of the few. What we have here is really interest rates against velocity of circulation of money. As a central banker, the only thing you can control is the monetary base. The monetary base is composed of the amount of notes and coins in circulation, the level of required reserves, and the level of excess reserves. And that's the only thing you can control. And from that you get a credit multiplier, and that expands credit in the system, and so on. So what we have here is I have interest rates on this vertical axis, short-term interest rates, and on the horizontal axis I have the velocity of circulation of money. And what you see is that when interest rates fall, you tend to see velocity of circulation decline with it. That's because when interest rates are very high, money is kind of like a hot potato. You don't want to keep hold of it, you want to pass it on. So at high levels of interest rates, money gets passed on quickly. As interest rates come down under the burden of quantitative easing and interest rates converge to zero, there really is no cost to holding money. I don't need to get rid of it, dispose of it very quickly, so I can keep hold of it. So the velocity of circulation of money falls very sharply. And so you see here today that the velocity of circulation of money is really very, very low. So given this relationship between interest rates and the velocity of circulation of money, it's no surprise that when you look at the annualized change in the monetary base versus the annualized change in the velocity of circulation of money, what you find is that there's a pretty good linear relationship between the two. What happens is that when the central bank expands the monetary base with quantitative easing, that raises M in the MV equals PY equation. But of course, as they quantitatively ease and they take interest rates down to zero, the rise in M is pretty much largely offset by the fall in V. So an increase in M, a fall in V, leaves PY constant. It has no real effect on nominal income. People are smiling because it's kind of true. It works. And it explains why monetary policy in a quantitative easing way doesn't really have a great role to play. The role of quantitative easing, in my opinion, was really just simply to ring-fence the deposit base of the banking system. That as long as you ring-fence the deposit base of the banking system, you stop runs on banks. If you stop runs on banks, that's a good step towards stabilising the financial system. Now, the effect of quantitative easing on the market, well, one effect could be that it could drive up equity prices. So what I did here is this is just a very simple regression of real GDP growth 1 year forward against equity market real returns. Very crude, very simple, but it gets the point across. The idea is that basically a 10% rise in the S&P gives you about a 0.32%, so 1/3 of a percentage point rise in US GDP. That's pretty much the balancing item or the error in the national accounts. So a 10% rally in equity markets doesn't deliver you much. You would need to see a 30% rally in the equity market before you see anything noticeable in US GDP data. So the idea that you can stimulate markets and then generate a wealth effect which stimulates consumption, which drives GDP, which is the argument that Ben Bernanke has used, is not very compelling. You know, the direct effect on velocity is pretty clear. The same relationship exists in Japan. This is monetary base growth versus the change in velocity in Japan. Perfectly linear. The problem the Japanese have had is that when you expand the monetary base, the velocity of circulation declines proportionally, and you have no net effect on nominal income. So it's not clear to us, at least, that quantitative easing will have a great effect on GDP through wealth effects. You would have to have an enormous rally in equity markets to generate anything like a wealth effect which is going to have a meaningful impact. So then you say, well, what happens when you want to come out of quantitative easing? Now this is the interesting point. When you want to come out of quantitative easing, it becomes much more problematic. As a central banker, getting into QE is quite easy. You can put all amount of money you like. You can expand your balance sheet to 2.5 trillion, 3.5 trillion. You pick a number, you can expand it. In theory, in principle, there is no limit to the size of the Fed's balance sheet. But what there is a limit to is the ability practically to reverse the policy. So, for example, if you think about QE2, QE2 has been, what, roughly 600 billion euros over about, $600 billion, over about an 8-month period. That's been done over an 8-month period. But looking at this analysis, it would suggest that if you want to reverse the policy and you want to tighten monetary policy at some point, you have to take out all of the quantitative easing in a very, very front-loaded fashion. It has to be very front-loaded, and that's the key point. Because what I have here is basically I have interest rates, 3-month treasury bills here, interest rates, Then along the horizontal axis I have what's called liquidity preference. So effectively this is money divided by nominal GDP. So you can see it's 1 over velocity. And so what you see is that interest rates come down very quickly. That's associated with very, very high levels of liquidity preference. So very modest, because of this non-linearity, a very modest rise in interest rates is associated with a very substantial reduction in liquidity preference. And so what you can do is, from this, you can estimate a very simple equation which will show you that to implement, let's say, just a quarter point rise in Fed funds, the Fed would need to remove pretty much all of QE2 in one go. The whole lot. Now, Charles Plosser, who's the president of the Philadelphia Fed, has talked about this in a paper that he wrote a few months ago called Exit. Made this point that you have to take large amounts of liquidity out. And Plosser made the point, I think, that if the Fed were to take Fed funds up to 2.5%, then they would have to pretty much take out about $1.7 trillion worth of balance sheet size from the Fed. You almost have to you have to really reduce it by over half the size of the Fed balance sheet to take Fed funds up to a normal 2.5% rate. So the key point here is that small rate rises initially have to be associated with very, very substantial reductions in the outstanding stock of the monetary base. Now, what happens if you don't do that? Well, if the Fed were to raise interest rates to try and normalize policy, what happens? Well, the first effect is that a higher level of interest rates probably gives you a higher level of velocity. So a higher level of velocity of circulation against the backdrop of a given stock of monetary base will expand nominal income and expected nominal income quite substantially. Now, we can argue about the separation of that between real GDP and prices, but I would probably argue that you're going to get at least some deterioration in inflation expectations. So you get the paradox of where a rise in Fed funds could be inflationary. Strangely. Tighter monetary policy could be inflationary, which is really not intuitive. And the reason why it's inflationary is because higher interest rates through tighter monetary policy increase the rate of velocity of circulation of money against the backdrop of a given stock of money that raises nominal income and inflation expectations. So the reversal of this policy has to be managed very, very carefully. One small mistake by the Fed, if they try to raise interest rates but they don't remove that liquidity, you could see interest rates rise really very significantly because inflation expectations will then start to rise very rapidly.
Excuse my ignorance, but how technically do you take out such an amount of liquidity in short time? How do you technically do that?
You sell lots and lots of securities.
Sell all the bonds.
You sell all the bonds. You sell lots of securities into the market. And you do large amounts of them. Because it has to be front-loaded. And this is a very key point. That getting into QE can be done in steps, but getting out has to be very heavily front-loaded. You're going to have enormous asset sales by the Fed in a very short period of time in order to prevent the reversal of QE becoming inflationary. So it can be done, but it's very practically it's very difficult to do that. Really quite challenging to do that. Okay. Maybe if I stop there. So we've talked about Europe. I think Greece, Portugal and Ireland are really beyond the point of return and that there will be some kind of restructuring default in their debt. Japan, I think, is likely to be the next victim in terms of a sovereign debt crisis at some point. That once their level of net domestic savings falls below their deficit, they find a difficulty in financing their deficit and they get to the brink of default. And then finally QE, the idea that another round of QE really would have minimal impacts. It wouldn't have much of an impact on the economy because the wealth effects are simply far too small. It wouldn't have any direct effect because of the velocity reduction offset. And then lastly, the idea that when you unwind QE and you reverse it, it has to be enormously and heavily front-loaded in order for monetary policy tightening not to be inflationary. So maybe if I stop with those three sort of key points and then we can sort of expand the discussion.
Thank you very much. Let me ask you questions first because people will be interested, I guess, in Spain and in China, and why it is technically hard to sell hundreds of billions of dollars in bonds.
Spain and China. Let's go to the table for Spain. Okay. Now, Spain is an interesting case. The Spanish debt position you see here, this is 2010 OECD data. So the Spanish gross debt to GDP ratio at 72% is meaningfully below the US, below the UK, below Ireland, below Greece, below Portugal. So on the face of it, Spain looks comparatively under-leveraged. But the problem in Spain is really the following, is that in the period after the implementation of the euro, in that 10-year period, then private sector debt in Spain almost quadrupled to the better part of 2.5 trillion euros. So the Spaniards ran a vast current account deficit. So prior to the euro, the Spaniards were quite prudent. After the euro, they started to run vast current account deficits. Basically, that huge inflow of capital financed huge excessive investment in real estate. That led to fragility in the banking system and the bank balance sheets. And so, in effect, what's happened in Spain is that Spain is in a difficult position because it's really nationalised the debts of the private sector banking system. So you've taken private sector debts onto the balance sheet of the Spanish government. So the debt to GDP ratio in Spain is probably a good deal higher than this if you add in the implicit guarantee they've made for private sector debt. Now, Spain, you can see, has a cyclically adjusted primary balance of about 4.5% of GDP. Would require about 0.5% surplus. So it needs about 5.5% fiscal policy tightening under equilibrium normal conditions. Now, assuming that they don't get the equilibrium growth that they expect and they are financing it above equilibrium real rates, this is probably somewhere more in the order of, let's say 7%, 8%, something in that region, depending on what assumptions you want to make. And you can look at the grid that we showed. You can read off your own assumptions for what you think for real growth and real interest rates. But let's say you have to do 7% of GDP fiscal policy tightening. Now, Spain had a kind of an early mover advantage. That Spain recognised the difficulties quite early and moved to implement fiscal policy tightening comparatively early. But the danger is in Spain that you could start to see some slippage. That Zapatero and the socialists took a really bit of a battering in the recent elections. And so if that were to lead to some slippage, then that could put Spain again back into the firing line with Portugal, Ireland and Greece. But the situation is, I think, that the Spanish moved early, and so got an advantage of being early movers. But the second you're getting slippage, Spain equally could find itself in substantial difficulty. Now, the issue with Spain is quite interesting. Let's go to other slides. There's an appendix slide on Spain, which we'll look at. Come back to this material on commodities at some point. The pigs need to turn German. So to expand on Spain, it's kind of interesting. If you look at the experience of Spain and Germany pre and post Euro, what we have here is this is household borrowing rather, the rate of growth of household borrowing in Germany. And this is the current account balance as a percentage of GDP. So this is the start of the Euro. So you can see that in a period prior to the Euro, the Germans were borrowing at a sort of growth rate of 7 or 8%, and they were running a modest current account deficit. When the Euro came into existence, you can see that the rate of growth of German borrowing declined very substantially. You can see that their current account went from deficit to surplus. So the Germans discovered the lost art of saving, just as the Spaniards discovered the lost art of spending. So the Spaniards and the Germans did exactly the opposite. In the period prior to the Euro, the Germans were borrowing and leveraging. The Spaniards weren't borrowing and weren't leveraging. After the Euro came into existence, the Germans started saving and effectively dislevered, if that's not a horrible phrase, when the Spanish went into large current account deficit and started to borrow aggressively. So I think the prescription really for Spain is the same for Portugal, Ireland and Greece. It's really to turn more German. They really need to follow the example of what the Germans did in this period after the implementation of the Euro. Now, that can be quite difficult because they need to run current account surpluses. If they run current account surpluses, from an accounting identity perspective, someone's got to run deficits on the other side. So if all the deficit financing countries need to run surpluses, you basically have to take away the surpluses or reduce the surpluses in all of the current surplus countries. And so what that means, inevitably and invariably, will be that the surplus of, say, China and other countries will have to diminish. You reallocate surpluses and deficits globally. Now, the issue with China is that I don't think the Chinese have discovered the miracle for eternal economic growth. If you look at China, the issue in China is that if you look at a production function, very simply, output growth is a function of multi-factor productivity, labour and capital inputs and productivity. Fairly simple Cobb-Douglas type framework. If you look at China, if you expand the labour supply aggressively and you add to that free or cheap capital, you put free or cheap capital next to large amounts of cheap or free labour, you're going to get rapid amounts of economic growth. But that can only go on as long as you have surplus factors of production to put into that production function. Ultimately, as you find in the US and everywhere else, the growth rate will be constrained by the level of productivity and by multi-factor productivity. And the evidence suggests that China doesn't have a lot of that. Alwyn Young, who used to be at the University of Chicago, and I think is now at the LSE, has published a number of papers looking at this, and it's pretty clear that the Chinese don't have large amounts of underlying multi-factor productivity. So China really is a product of vast expansion of the inputs of factors of production, labour and capital. That's really sort of coming to an end. Because when you look at the rate of growth of these emerging markets, and China will be a good example here, the black line is the difference between the growth rate in emerging markets and the growth rate in the developed world. So you can see for most of the 80s and 90s, they were broadly similar. Emerging markets grew slightly faster. The orange line is the advanced economy current account balance, broadly kind of neutral. Just as the Western economies went into deficit, and you can see it's inverted, so when the Western economies, the advanced economies, decided to run large deficits, the emerging markets started to grow more rapidly relative to the developed world. So in effect, the emerging markets entered into really a trade finance relationship with the West. The emerging markets, and China in particular, grew very rapidly simply because the Western economies were prepared to leverage and run large current account deficits on the other side of that. Now, when the Western economies decide not to run large current account deficits, and they start to decline, we think what happens is the emerging market growth rate will converge back onto the advanced economy growth rate, as it was prior to this period of leverage in the Western economies. Now, you could stop that by expanding domestic credit, by stimulating the domestic economy and hoping that consumption can replace exports. Now, the Chinese, to a degree, have tried that. $1.5 trillion worth of new bank lending last year, and $450 billion so far this year. So large amounts of credit have been injected into an economy which is internally relatively supply constrained, and that's generated inflation. And so you have the problem that when you try and turn around the oil tanker and become less externally focused to become more internally focused, you generate inflation domestically. And so the problem in China is that they're now having to tackle the consequences of excessively easy monetary policy in response to the crisis driven by the external adjustment forced by lower leverage in the Western economies. So China really, I think, is in a situation whereby the Chinese growth rate will slow. China's structural achievable growth rate is much, much less than it has been in recent years because the sustainable current account deficit in the advanced economies is much, much lower than it has been in recent years because that debt can no longer be financed.
Okay, questions? Everybody, I guess, is over. Yes.
So, Paul, when do you think it's the time to start buying stocks of the Greek companies?
It's kind of interesting, actually. We don't really look at Greek equities because the market is comparatively small for us, so it's not a market that we've paid a lot of attention to. But the point I think you're making is the right point, is that generally speaking, the best time to buy equities is at times of crisis. It's invariably always the best time to buy. Now, let me answer that in a roundabout way by covering this. What we've done is we've built an equity ranking system. Because when you look at equity portfolios, a lot of people in my industry will tell you that you have to pick stocks. You have to be a good stock picker. But if you look at the people like the work of people like, say, Rauenhorst, who's published in this field, we've done our own research, but if you look at Rauenhorst's work, and amongst others who've followed it, generally speaking, about 70% of the total return across the course of the cycle in an equity portfolio will come from the country selection decision. 30% from sector and stock. So, if you're an investor, the most important decision you make is the country decision. It's not stock and sector. You can buy a good company in the bad country and lose money. Buy a bad company in a great country and you just get carried along by the tide and you make money. And so what we decided to do is try and rank global equity markets on the basis that this was the single most important decision that you take. And we took a sort of four-factor approach: valuation, risk, growth, and momentum. Now, this may be heretical to sort of financial academic economists who would believe in the Chicago school. I don't really come from a Chicago school background, so I don't really sort of see this as heretical. I take more of the path of Robert Horgan, I think is probably more enlightened. So valuation gives me the bias and the distribution of implied returns. Risk gives me a measure of the margin of safety, or the drawdown in protection. Growth, let me come back to. Momentum. Momentum clearly has an effect. The work of people like Cliff Asness, for example, shows very clearly that when you look at momentum, you have a strong positive effect. And particularly when you combine momentum with valuation, because of the way they correlate, you get a higher Sharpe ratio, if you like that kind of thing, from value-adjusted momentum or momentum-adjusted valuation types of signals. So that matters. Then growth. We look in here at growth. We don't think of the economy in the normal way. If you look at it cross-sectionally through time, the correlation between economic growth rates and equity market returns is negative. People like Dimson, Marson Paul, Jeremy Siegel, people like Jay Ritter, for example, have published large amounts of work in this field, showing that if you look through the last century, for example, I think in the Dimson, Marson Paul data, the correlation across markets through time between equity market returns and economic growth is about minus 0.27. I think it's 0 in the post-war period. So basically there is no positive correlation. Now the work of people like Peter Blair Henry, I think at Stanford, is published on emerging markets, shows exactly the same correlation. Emerging market growth is negatively correlated cross-sectionally with equity returns. So the way we look at growth is that I don't think growth really matters to an equity investor. Growth, it may sound crude, it may sound strange, but growth is very largely irrelevant to an equity investor. The way we look at growth is really the way that you would look at a company. If you were a private equity investor buying a company, you wouldn't go in with a laptop and a spreadsheet forecasting economic growth. What you'd do is you'd look at the income statement, the balance sheet, cash flows. You'd want to know whether the company was sustainable and stable. And so we look at the economy in the same way. We look at a term that we call disequilibrium adjustment. And it's the idea that we want to look at whether the economy is in disequilibrium or in equilibrium. So how far away from its trend path is the economy? And so we have multiple variables within each of these buckets, and we weight them together in a particular way. And we can send you the details of this, but this is no secret, it's not a black box. The only thing we don't tell people is the weighting that we apply. But everything else you could replicate.
You can probably replicate the weighting if you have 20 times.
Exactly. Well, you could replicate the weighting if you wanted to. You could probably work out what the weightings are anyway, it's not difficult. And so within valuation, we have a lot of normalized, normative valuation measures. So price versus trend earnings, market cap to GDP ratios, several different measures. Risk, we have things like an implied equity risk premium, market beta, there are some exchange rate terms in there. Growth, as I said, is a deviation from trend term, and momentum is a series of simple moving averages. If you combine them together, you get a ranking. You can rank them in each bucket. So in order of preference, the 5 best markets for us at the moment would be Italy, France, Germany, Turkey and Japan. The 5 markets we prefer best of all.
So GRI is for Germany?
It's Germany. Now let me come to Greece very shortly. I'll get to Greece very shortly. And the key point is that the ideal conditions. What are the ideal conditions?
Already send a message to buy Greek.
So what are the ideal conditions in which you should buy an equity market? Well, they are where valuation is low, where the real exchange rate is depressed, where the risk premium is wide, where the beta is low, where the economy is on its knees, but showing some signs of improvement, and where momentum is favourable. So apply that to Greece. Well, the economy is clearly on its knees, there's no question about that. Valuation is low, there's no question about that. The risk premium is clearly wide, there's no question about that. The beta is not unduly concerning, that's not a problem. The real exchange rate, well, that's the euro. That could be a little bit of a problem, but the euro is not substantially overvalued. We think it is a little bit overvalued, but it's not enormously overvalued. And so, we don't include Greece in here, but if you were to include Greece in here, I would say now is a reasonably good time to buy Greek equities. Buying distressed assets at times of distress is a good thing. Think about your own experience here in Russia. Think about the crises that this country has had. With the benefit of a time machine that could take you back, you would want to go back to each of those crises and you would buy assets. Now at the time you didn't want to because you thought the world was coming to an end. But with the benefit of hindsight, you would go back to each of those crises and you would hoover up assets. Crises are the best time to buy assets. In a time of crisis, intelligent people sell good assets at silly prices. And that's the kind of situation that you find yourself in now. So I like the idea of buying good Greek companies.
And the reason you haven't included Greece in this table is?
Really just because it's a comparatively small market that doesn't really fit on our radar. No, for no reason than that. We could expand this to Greece. We could, there are a number of other markets that are missing. There are also some other key markets that are missing. Really just because we haven't really focused on them, to be honest.
So your clients could have bought the whole Greek economy if they wanted to.
Doesn't it worry you that we don't know the terms of construction of big debt, and that will affect some of the variables in the debt?
Yes, I mean that's obviously a concern. That's why you don't kind of pile in fully and buy Greek assets as they are. You want to somehow get a better understanding. But in a way, that's a degree of uncertainty. The reason why the risk premium is in here is to compensate you for that uncertainty. There is always uncertainty. So, for example, there will be uncertainty about the path of the economy, uncertainty about the path of restructuring, uncertainty about political economic events, whether somebody's going to run for a presidency or not, who's going to compete with them in a presidency election. There are all these issues that are constant sources of uncertainty. And the reason why the risk premium, the implied equity risk premium, is in there is as direct compensation for the unknown and the unknowable. And so I would say to a degree the risk premium probably reflects that. I mean, for example, Greece. If you look at credit default swap spreads in Greece, it's pretty much priced for default. It will default. And if you look at the analysis that's been done in a number of places, people are talking about haircuts in the range of 70 or 80%. So you could apply those kinds of scenarios. You could work on a scenario whereby I assume a 70 or 80% haircut, an extension of the debt, and it happens at this point. You could see whether the risk premium is compensated. And I would guess that the risk premium probably is reasonably compensated for that kind of event in Greece.
Other questions? Yes, please.
I have two questions. First one is concerning inflation. On your opinion, when can we see the start of inflation cycle in the developed world? Is this something in the near term, or this is not actual for the near 2 to 3 years? And the second one is about evaluation models. Do you see company dividends as an important factor in your valuation models, or this is something that you don't put attention to?
Let me take the second one because that's the easiest one. Do we take dividends into account? Yes, we do. Because when we value the market, we basically work on the basis of calculating the implied risk premium. The implied equity risk premium is the implied equity return relative to, let's say, the real risk-free rate. Now, the implied equity return is a function of the starting valuation ratio, the terminal valuation ratio, the trend rate of EPS growth in between, and the dividend yield. So it's a Gordon growth model. So within a Gordon growth model, dividend yield plus real EPS growth plus multiple change gives you total return. So it's really a Gordon growth model type of approach. And so dividends are important. If you look at equity markets historically, and you break the return into dividends plus EPS growth plus multiple change, the dividends plus EPS growth is really the carry part, and the rest is capital gain. And generally speaking, if you look at the Dimson, Marson, Staunton data, let's say as much as 70% of the total return in markets comes from the carry component. So dividends are vitally important, absolutely crucial. You know, dividends matter, they really do matter. Now you could also say that they matter in terms of EPS growth. There's a very good paper by Cliff Asness. I think Cliff Asness wrote it, or Robert Arnott. Yes, Robert Arnott wrote a paper basically looking at the relationship between dividend yields and EPS growth. The idea that when the payout ratio rises, that's a good predictor of future EPS growth. So a high dividend payout ratio is a predictor of more rapid future EPS growth rates. So dividends and dividend payout rates matter. They really do as an equity investor. Vital. Now, inflation. When do we think there will be inflation in the Western world? Well, the first key point is that there really is and has been rampant inflation in the Western world. You just didn't notice it. Think about the economy in this way. Break the economy into the real economy and the monetary economy. Two parts. Real economy, monetary economy. So in the real economy, people make cars and furniture and shoes and clothes. In the monetary economy, you buy and sell commodities, houses, bonds, equities. Think about inflation as, and the distribution of inflation as a function of the relative elasticity of supply. So think about the elasticity of supply in the real economy. Well, if you take the IMF data, in emerging Asia, investment is fast approaching 41% of GDP. Globally, investment is approaching 23% of GDP, so the highest since records began in the early 1980s. So the world is awash with investment, largely from emerging Asia. So what does that do to the supply curve in the real economy? Well, I think it makes the supply curve very elastic. So the real economy has a very, very elastic supply curve. So when you move demand against a very elastic supply curve, what happens? Output goes up or down, but prices are largely fixed. So the elasticity of supply in the real economy means that prices are largely stable, with volatility being experienced in output. So all the volatility in the real economy is output, not prices. In the monetary economy, think about the relative supply curve there. The supply curve in the monetary economy is vertical. is highly inelastic. There are only so many houses that can be built or exist at one point in time. There's only so much oil that can be extracted. There's only so much lead or copper or bauxite that can be got out. The supply curve is really quite inelastic. If you increase or decrease demand there, what happens to output and prices? Well, you get prices going up and down, but output doesn't change. So if you think about the experience of the last, say, 10 or 15 years, we had the biggest credit boom in history. And yet we saw no inflation in the shops. Nothing. OECD core inflation was stuck at about 2%. Has been for over a decade. So there was no inflation in the shops at all. But what we saw was rampant runaway asset price inflation. Houses, equities, credit, you name it. Rampant runaway asset price inflation. So we did see booming inflation. Now, central bankers tend to focus on the real economy. So their objective function is the real economy. They look at the real economy and they say, well, inflation is very well contained, so monetary policy is appropriate. So they ran an excessively easy monetary policy in response to a very, very elastic real economy supply curve. At the time when the monetary economy was inflating and the balance sheets of banks were expanding, and so effectively they sowed the seeds for the collapse of the banking system because they were looking in the wrong direction. They weren't looking in both directions, they were looking only at the real economy. Look at it today. We've had substantial amounts of monetary injections. The Fed balance sheet stands at roughly $2.5 trillion. We've had huge monetary injections really everywhere. You're seeing inflation. It's there. You don't see it in the shops. It's not really in the shops. You're seeing inflation in food and energy. Energy really because of sort of supply shocks related to Middle Eastern upset and worries. But you're seeing inflation in equity markets. Take the US equity market. It's a classic example. You see it very clearly in the US equity market. Let me show you. Just get through this a second.
We see it very clearly in the commodities market.
Absolutely. So if you look at the US market, this is the price versus trailing 10-year earnings, nominal earnings. So when you look at Schiller, he takes the price versus real earnings. I'm not sure I understand why he does that, so I think price versus nominal earnings. I don't understand why he looks at it that way. And I'm not the only one, I don't think.
I think he does price corrected for CPI inflation.
But he takes the price divided by earnings corrected for CPI inflation.
Yeah, that's strange. He should correct both.
Yeah, exactly. I don't know why he just corrects the denominator rather than the numerator. But he does. So we just take price divided by nominal 10-year earnings. This is back to 1910. So you can see that basically today we're at roughly 26.5 times. That's in the 10th percentile. So if you go back to 1870, we're in the 10th percentile for this valuation ratio. Now you could say, okay, well the market is only trading at 13 times 1 year forward operating earnings. Fine. But any valuation measure that you suggest to me as a measure of valuation has to be able to predict returns. And the price versus 1 year forward operating earnings doesn't really predict returns. It's a useful analytical tool for investment bankers because they can play around with forecast earnings, but it's not a useful valuation tool for the market, in my opinion. What you see here is this is the implied return. This is the realised return broken down by quintile. So you take that valuation ratio, break it down into quintiles, and you calculate the median real return by quintile. At this valuation level, the market is implying basically next to no return. Virtually zero return. So you are seeing rampant inflation. The effect of monetary easing has been to inflate monetary asset prices. It's inflated commodity prices. It's inflated equity markets. And so you do see inflation. You just don't see it where you would expect to see it. And because the distribution of inflation within an economy is a function of the relative supply elasticity. That's how you distribute inflation between sectors.
Just playing the devil's advocate. So first, you can look at, say, asset prices. You can look at housing prices in the US, the sugar index. It's already come down quite a bit. But if you look at the futures, I think it will be still above the long-term average. If you look at the futures on case sugar index and divided by, say, rent, annual rent. And in that sense, you can argue that the financial system has changed. There's been a lot of innovation. Some of that has been real. And that means maybe we cannot use long-term averages because now financial system is more efficient. And interest rates, equilibrium interest rates will be different, something like this. practical.
I think the argument that the financial system is more...
Which means asset prices should be higher.
I think the argument that financial markets are more efficient is a difficult one to argue when we've gone through a financial crisis. I think it's very hard to argue that the financial system is more efficient when it collapsed. It's the first.
No, I think the argument here would be, we thought it's very efficient, but it's just normally a little bit more efficient.
I guess we get into the Chicago arguments about whether it's weak form or strong form efficient.
Exactly.
Well, I would say it's super weak form efficient, frankly, given that the system collapsed. Given that if the Fed hadn't done what it did, the whole system would have imploded. I think that's an argument for super weak form efficiency, not just weak form. Certainly not an argument for strong form efficiency, as some people have argued. But I think in terms of have things changed, yes, of course things change, but mental arithmetic never changes. The source of return in an equity market never changes. The total return on an equity market is really quite simple. It's the dividend yield plus the rate of growth of real EPS plus the multiple change. Now, the rate of growth of real EPS, for example, in the US market has been roughly about, in real terms, roughly about 1.5% a year annualized, really since 1870. It hasn't changed. If you take Bill Schwert's data, you can go back to, I think, 1802, you have really 200 years where you have really no change in the discernible trend of real EPS growth. From peak to peak or trough to trough, nominally, it's about 6%. So I'm pretty comfortable on the basis that things haven't changed in the last 200 years, that they aren't really changing that much now. So I'm happy to work with the notion of, let's say, 1.5% real EPS growth rate. Now, the dividend yield is kind of what it is. I know what that is. And now, in terms of the price-earnings ratio, well, I know that historically, price-earnings ratios do linearly correlate with returns. I mean, it's clear here. Now, if you look at price versus normalized earnings, the price versus normalized earnings does correlate with realized real returns. And so there is some sense that there is some mean reversion in PE ratios. Now, you could argue about mean reversion in PEs and systemic failure and so on. And the reason why the US has it is because there's been no systemic failure. But I think it's when you add the three together, when you add the dividend yield at 1 and a bit, you add EPS growth rate at 1 and a bit, and you look at the PE multiple, which is in a 10th percentile of the distribution for 140 years, it's, I think, quite plausible to argue that the implied path of returns is really quite modest.
We probably have time for one more question. Yes, please.
Paul, I have a question to you as a professional investor. I'm concerned the last, let's say, astounding IPOs of internet companies, especially could you please comment on the extremely high price multiples of the company? What do you think about it?
How does that refer to this?
I didn't put it in. I really should. I'll send you something afterwards, actually, because we've done some analysis on this. A similar analysis from the NASDAQ. Now, the first key point is a lot of people are suggesting that there's a bubble in the NASDAQ, and a bubble in tech stocks again. Now, it kind of gets down to sort of semantics, really. What is a bubble? Now, when I think about a bubble, I think about a bubble in the following way. I think about a bubble as a negative implied risk premium. And I think about the implied risk premium as really the difference between implied equity returns and the real bond yield. Now, from a Gordon growth model, the duration of equities is 1 over the dividend yield. You can do the math quite simply. So that gives the US equity market a duration of 50. So ideally what I'd like is a bond with a 50 duration, but I don't have a 50 duration bond. So if I use a constant 10-year duration bond, that's a good approximation as a practitioner. And so when I look at it, if I calculate the implied return to the NASDAQ, it's really a function of the starting PE, the starting dividend yield, the assumed rate of normalized EPS growth, and then the terminal valuation multiple. If you look at a rolling 10 or 20-year annualized rate of growth of EPS for the NASDAQ, it's between 10 and 13%. So these companies do tend to generate faster EPS growth than dull, boring S&P 500 companies. If you look at the price-earnings multiple on price versus trading 10-year earnings, they're in the low 40s. So you're basically at the kind of long-run trading median. So on that basis, you're at the long-run 2-decade trading median valuation multiple. So then if you say, well, I know what the dividend yield is, I know what the EPS growth rate is, I'll assume that it's going to be roughly 10% nominal annualized, which is the sort of long-run trend. I can calculate the implied level of return. And if I compare that to the real 10-year bond yield, I get a measure of an implied equity risk premium. If you do that analysis, back in, say, 2000, it was negative. the implied equity return, using that simple Gordon growth model expanded, the implied equity return was below the real bond yield. Today, the implied equity return is above the real bond yield. So I don't think there is a bubble, technically, in the NASDAQ. From a sort of quasi-academic point of view, I don't think there's a bubble, because the risk premium is not negative. Now, do I think there are individual stocks which are overvalued? Absolutely. There's no question you can get individual stocks which are substantially overvalued. And if I look at things like LinkedIn and maybe some others, they to me don't look like attractive investment opportunities, to be honest. Right. I'm kind of a believer in Siegel's book. You've never seen Jeremy Siegel's book about the triumph of the tried and the true over the bold and the new. Now, I think dull and boring is always better than hot and sexy. That's because I'm English. Dull and boring is always better than hot and sexy. Give me a dull, boring company with a dividend yield and a reasonably predictable EPS growth path, with a reasonably easy to understand business model, with a reasonable ring fence to its cash flow. I'd always buy that rather than the hot, sexy tech stock.
There are people in the US who believe that too. Okay, thank you very much. Short Facebook. Thank you. Thank you. Paul's slides are available on our channel in SlideShare, and this video is available at our channel at YouTube. Thank you very much. And he will some more slides we'll put on the SlideShare.